time, if you're considering buying 3.5% down or less, you're probably weighing out these two top options: the conventional 3% down or the standard FHA financing.
Did you know that you can buy with a conventional loan with only 3% down? I'm a licensed real estate broker and loan officer in California. I've been in the mortgage industry for over 20 years, and I've helped thousands of buyers get into their first home with these type of low down payment programs. In this video, we'll discuss the conventional 3% program, who the program benefits, guidelines, credit events. I'll share a buyer's experience using this program and a visual cost breakdown of his purchase details. This loan is designed for borrowers that have excellent credit, carry less debt, and they're looking for single unit homes with the 3% down, and also looking for the lowest long-term costs. Many buyers don't realize that the conventional 3% carries no upfront mortgage insurance, and PMI can be canceled once you reach the 20% mark, something FHA loans do not offer, unless you put 10% down. If you have stable income and a credit score of 620 or higher, you could technically purchase with this program, but if you're under 680, then I would highly recommend the FHA. You'll get better rates and better PMI rates. FHA loans are more forgiving on credit and income requirements. They allow you to buy 2 to 4 units with only 3.5% down, and they allow you to carry more debt. Here are the basic guidelines for this program. These are the eligible property types. They include single-family residence, condos, PUDs, and SFRs with ADUs are also permitted. Credit scores. The minimum credit score is technically 620, but again, if you're below 680, FHA is your way. Debt ratios. The maximum debt ratio is usually 45%. However, when you have a 700 score or higher, then your ratios can actually go up to 50%. Occupancy. The home must be owner occupied. Income limits. There are no income limits for this conventional 3% loan. Seller assistance. The sellers can pay up to 3% in closing costs on this program. First-time homebuyer requirements. First-time homebuyer requirements. At least one buyer must be a first-time buyer. A first-time buyer is defined as anyone who hasn't owned a home within the last 3 years. Here are the credit event guidelines. Bankruptcy Chapter 7. You need 4 years after the discharge. BK Chapter 13. 2 years from the discharge or dismissal. Foreclosure, 7 years after the completion. Unpaid collections. Unpaid collections are allowed, but they can impact your mortgage insurance rate. Unpaid charge-offs. Unpaid charge-offs should be resolved for best pricing and loan terms. Meet David, a first-time buyer with a 760 credit score, had about $22,000 in savings. He was able to purchase a $700,000 home putting 3% down. And here's a visual breakdown of David's transaction. Here's his total purchase price, the closing cost, and the total acquisition cost. Then here's the loan amount, seller paid closing costs, and this was his total out of pocket. If you have a realtor ready, we can work together with them. If you don't have a realtor, I can connect you with realtors that are great at getting offers accepted with low down payment programs. I hope you found this helpful. Go ahead and hit the like button and share this with someone who could benefit as well. And don't forget to subscribe to get our latest videos. I'll see you on the next one.